In statistics, the statistician, they say that what is the risk? They say standard deviation from the mean value is known as risk. For example, that this is the mean value. If mean value of an investment on average they earn, for example, there is a $3,000, 3,000 rupee. This is the average income, and this horizontal line is a standard deviation, 500, 1,000, and this is 500, and here 1,000. This is negative region, and this is positive region. It is quite possible that this is the average income, the investment earn in a good way, then they will earn, the standard deviation will be 500. And if it move on the other side, negative 500, then this, it is quite possible that they earn, if they earn this standard deviation, then they will make $3,500 or 3,500 rupee. If they move here, then they face loss and they will get only 2,500. So this is the quite possibility. If we make a bell shape, then this would be the bell shape that in this statistics. Okay, let's take another example. That same mean value of average income, this is the average income, and if the standard deviation is big, so they move, look at here, in the positive side they will earn 4,000, and in the negative side they lose, then they will earn 2,000. Look at here that this is the region. So what we are looking in this graph, we see that the standard deviation was low, their earning is low. Standard deviation is high, their earning is high. So it gives us a principle that higher the standard deviation, higher the risk, then higher would be the profitability. If lower the standard deviation, lower the risk, then lower would be the earning upon the investment. So that is why the statistician says that, look at here, this is the standard deviation, it is a small and it is a big standard deviation. If as the standard deviation is big, their profit is big. If the standard deviation is low, the profit is low. So in statistics, they call that standard deviation is usually equal to risk. So how, and the negative side, look at here, because their standard deviation was low, so that is why they were facing very low loss. So their standard deviation was high, so they were facing a high loss. If they face loss, then their income will become 2,000 rather than average income 3,000. So it will. So this is the case of risk in conventional as well as Islamic economic framework, because Islamic economics also says that risk profits are associated with risk. If there is no profit, if there is no risk, there would be no profit. If there is high risk, then there would be high profit probability, and if there is a lower risk, then the probability is lower profit.